China's property sector is facing one of its deepest crises in decades, with implications not only for the domestic economy but also for global markets. What began in 2021 with the defaults of heavily indebted developers such as Evergrande has evolved into a structural challenge that threatens to undermine growth, stability, and investor confidence. The roots of the crisis lie in years of overbuilding and excessive leverage. During the boom years, developers borrowed aggressively to expand, often beyond sustainable levels of demand. The introduction of the Three Red Lines policy in 2020 sought to curb borrowing and force, but the restrictions also accelerated the liquidity crunch for weaker firms. At the same time, demand for new housing has declined as homebuyer confidence fails. Inventories remain high, and many projects are delayed or abandoned. Mortgage boycotts by frustrated homeowners have further undermined trust in the sector, creating a feedback loop of falling sales and dwindling cash flows. The financial strain has been compounded by looming debt repayments. Many developers face large bond maturities, yet refinancing options are scarce, especially in offshore markets where investors' appetite has shriveled. Banks, shadow lenders, and local governments are all exposed to the sector. For municipalities, the crisis is especially severe. Land sales, once a major source of local revenue, have collapsed, squeezing fiscal capacity just as economic support is needed most. The ripple effects extended throughout China's financial system, raising concerns about non-performing loans, shadow banking fragility, and localized fiscal crisis. Beijing has responded with a mix of stabilization efforts and selective deregulation. Authorities established a financial stability committee to monitor risks more closely, while also discussing the launch of state-backed funds or trusts that could provide liquidity to viable developers. Some proposals involve injecting capital via convertible preferred shares, effectively giving developers a while ensuring some state control. At the same time, regulators have loosened borrowing rules for healthier developers to prevent a complete collapse of the industry. Despite these measures, defaults continue. Some developers are delisted and offshore bond holders. Policymakers appear to be walking a fine line, avoiding a full-scale bailout that could encourage reckless behavior while preventing systemic contagion. The risk remains significant. A prolonged property slump directly slows China's economic growth, given that real estate and related industries have historically accounted for a quarter or more of GDP. Banking stability is at stake, as exposure to property developers and mortgage lending could trigger rising non-performing loans. Internationally, investors and creditors face losses, while commodity markets are already feeling the impact of weaker construction demand. Copper, steel, and cement markets, all heavily tied to Chinese building activity, may remain under pressure. Social and political risks also loom large, as delayed housing projects, financial losses, and mortgage boycotts fuel public frustration, adding pressure on authorities to act decisively. Looking ahead, several questions will shape the trajectory of the crisis. Will Beijing move forward with a large-scale stabilization trust or fund? And if so, Who will be deemed worthy of support? How will local governments adapt to declining land revenues? Will they borrow more, cut spending, or risk fiscal distress? Will the government adjust or abandon the three red lines policy to ease financing for developers, or maintain discipline to prevent a return to excessive risk taking? At the same time, investors are watching closely to see whether defaults escalate, whether bond recovery rates improve, and how much of the sector's restructuring fails on domestic versus international creditors. Globally, the implication extended beyond China's borders. Commodity exporters from Australia to Brazil depend on Chinese demand, and the prolonged downturn in construction activity could reshape global trade flows. Financial markets are also sensitive to shifts in Chinese investor sentiment and capital flows. If confidence in China's stability falters, emerging markets elsewhere may face higher risk premiums, lighter financing conditions, and contagion effects. More broadly, the crisis offers lessons for economies worldwide. It illustrates the dangers of over-reliance on property as an engine of growth. The vulnerabilities created by excessive leverage and the difficulty of balancing the leveraging with financial stability. In short, China's property sector remains one of the largest sources of financial risk in the global economy today. While authorities are taking steps to prevent collapse, the underlying problems of oversupply, weak demand, and unsustainable debt cannot be resolved quickly. The outcome will likely be a drawn-out restructuring process with continued defaults, selective bailouts, and uneven recovery. For investors, policymakers, and global markets, the sector's trajectory will be a defining factor in reshaping both China's economic future and the balance of the global financial stability. The continuing uncertainty surrounding China's property sector is shaping not only domestic policy but also global investor strategies. In the near term, markets are bracing for more defaults, restructuring, and ad hoc interventions. Developers once seen as too large to fall are now facing existential challenges, with investors learning that even big names may not be spared if they cannot meet obligations. International creditors, in particular, have been forced to reassess risk. Offshore bonds that once attracted global funds with high yields are now widely viewed as distressed assets, and recovery rates are expected to be low. This has prompted many global asset managers to scale back exposure not just to Chinese developers, but also to broader Chinese equities and bonds, fearing that hidden risks remain.